Canada for many years. I encourage everyone to not just view land acknowledgements as something that references history, but as something that shows you a pathway forward towards reconciliation, and specifically economic reconciliation. For many in the room who work in the Canadian business arena and are unsure of where to start, I suggest TRC recommendation number 92. My name is Megan Daly, and I'm pleased to welcome you here today. I'm the president and founder of Forward Vision Games. We create financial simulation games focused on the financial skills needed for the future of work. I'm proud to serve as a member of the Economic Club's advisory board. Each year, the Economic Club hosts over 100 events across Canada, featuring discussions about the most important economic and social issues of our day. Our annual partners are key to allowing the great work we do to continue. The partners in the room with us today are PwC, CPA of Ontario, and the Canadian Bankers Association. Thank you for your support and for being here. Today's event is of the utmost importance well beyond the borders of Bay Street. We'll be hearing from Senior Deputy Governor to the Bank of Canada, Carolyn Wilkins. She will be discussing central banking in a slow growth world and how taking the long view will put Canada in a strong position to face the challenges confronting the world economy. First, we'll be hearing directly from Carolyn, and then we will invite Neil Palmater from the CBA to the stage, and he will lead our engaging conversation. We'll be wrapping with a Q&A opportunity, so please have your questions ready. Before we begin, I would like to provide some background on the depth of talent we'll be welcoming to the stage today. Neil is the President and Chief Executive Officer at the Canadian Bankers Association. In his role, he advocates on behalf of Canada's banking sector for policies and perspectives that contribute to a sound, successful banking system for all Canadians. Neil has more than 25 years of financial sector experience. Before leading the CBA, Neil was at TD Bank Group as a Senior Vice President, Corporate and Public Affairs, and Chief Communications Officer. There he counseled key executives on government relations, communications, and public affairs issues. Carolyn Wilkins has been Senior Deputy Governor at the Bank of Canada since 2014. In this capacity, she oversees the bank's strategic planning and economic and financial research. As a member of the bank's governing council, she shares responsibilities for decisions with respect to monetary policy and financial system stability. She oversees the bank's analysis of internal or international economic developments in support of monetary policy decisions. Ms. Wilkins is the Bank of Canada's G20 and G7 deputy. She represents the bank on the Financial Stability Board plenary and is a member of the FSB's Standing Committee on Assessment of Vulnerabilities. She's also a member of the IMF's High-Level Advisory Group on FinTech. She previously represented Canada on the Basel Committee on Banking Supervision and co-chaired its working group on liquidity. Prior to her appointment as Senior Deputy Governor, she was advisor to the Governor with a focus on the Canadian economy, its interaction with the financial system, and monetary policy. Previously, she also led the development and implementation of extraordinary liquidity tools and collateral policy deployment during the financial crisis. Please join me in welcoming Carolyn Wilkins to the stage.
Well, thank you very much for that warm welcome, and hello everybody. It's just great to be here in Toronto. I think what I'll do is just first thank the Economic Club for the invitation, and just tell you here that I see a lot of faces that are familiar, and it's good to see you here. What I'd like to speak with you today about is long-term economic growth, economic prosperity, and how we can support it, both here in Canada and in advanced economies. Now, the global economy has grown over the last 10 years by about 40%, and unemployment is near historic lows in many countries, including Canada. But at the same time, the political and social context is troubling. The trade war that's between the United States and China has contributed to a slowdown in economic growth, trade, investment at the global level. Now, there have been some welcome developments recently. The U.S. and China have reached an initial deal. The Canadian, U.S., Mexico agreement is near ratification. And so that is welcome. But there's still plenty of uncertainty about the global environment. You just think about the tensions in the Middle East, They've had tragic consequences for Canadians and for others. And we have the coronavirus. So that's what's happening right now. But what I want to talk about today is not losing sight of longer-term forces that are also at play. Our aging population and weak gains in productivity are weighing on trend growth. And we've all seen that. And lower economic potential means fewer business opportunities. It means fewer jobs. That matters to all of us. Well, clearly, the underlying state of economies around the world also affects how well central bankers like me can do our jobs. Slower trend growth is one of the reasons why R-star is lower than it used to be. And I'm going to talk a lot about R-star, so I'll tell you what I mean by that. It's a math shorthand for what economists call the neutral rate of interest. So the R refers to interest rates, and the star refers to the neutral rate, or just any equilibrium value. And it's a really important concept because it's the interest rate where monetary policy neither stimulates nor holds back economic activity. So it's important for us. It's also important for you because it's an anchor for where you can expect your economic returns to be. Now, given that the neutral rate, or R stars, are lower today, central banks have less room to stimulate the economy by cutting interest rates. And because of this, some have begun to worry that central banks won't have enough firepower to respond to a downturn. Some even argue that without that firepower, advanced economies like Canada are destined to suffer chronically slow growth and weak demand. And it's a condition that you might have read about in the newspaper called secular stagnation that's been talked about by many, including Larry Summers. And what it refers to is situations where R-star falls so low that it's extremely hard to nurse a sick economy back to health. And the Japanese experience is often pointed to as an example of this. And so in my remarks today, I'm going to make 3 points. The first is Canada is not experiencing secular stagnation. Nonetheless, we are affected by the same forces that are taking the wind out of the sails of trend growth and R-star across advanced economies. Second, well, we can navigate a world with low neutral interest rates. To do so, we need the right monetary policy framework, and we need the right tools in place. And third, Japanese-style secular stagnation isn't written in the stars. Building prosperity, it's up to us. The best policies to guard against stagnation and improve living standards are those that raise the trend line for growth and lift our star. Now, I'm going to get started by going back to 2014 when I had my first speech, which happened to be in Toronto, and I was talking about the main forces that are lowering growth potential for advanced economies, and that's demographic trends and slow productivity growth. And at the time, I said that these forces explain why potential for growth in advanced economies, including Canada's, have slowed from around 3% in the 1990s to 2% today. That's a big slowing. They also explain why R-star is lower. It's pretty intuitive. I mean, firms who are in this environment think that, well, I need to invest less because the return on my investment isn't going to be that high, and also the returns are a bit uncertain. And the trade war that we're experiencing today only reinforces this hesitancy. Well, there's also a glut of global savings that has pushed R-star down as well. And research points to a number of factors. Again, they're pretty intuitive. Retirement savings are higher as people are living longer. People in emerging economies are saving more for a rainy day as well because there are gaps in the social safety nets in those countries. And Canada, being the small, open economy that we are, is under the influence of these global factors, which are playing a leading role in determining Canada's R-star. Now, estimates that we have, the most recent ones, are that for advanced economies, R-star has fallen from 5% in the early 2000s to 3% today, actually below 3% today. And Canada's not an exception to this. And what that implies for central banks, when you think about it, is that we have 200 basis points less room to stimulate the economy in the traditional way. It's one thing to say that trend growth is slower and that R stars are lower than they used to be. I agree with that. It's another thing to say that R stars have fallen so low that advanced economies are experiencing secular stagnation. And I'm going to walk a little bit through the Japanese experience because it really brings this to life. Many of us remember that Japan was an economic success in the 70s and the 80s, and until the 1990s. And then at the beginning of the 1990s, equity markets crashed and the housing markets collapsed as well. And this led to more than 2 decades of slow growth and falling wages and periodic bouts of actual deflation. And that happened despite significant and sustained support from monetary and fiscal policy. Japan's central bank has maintained an unusually accommodated monetary policy. Interest rates, just as an example, have hovered around 0 for decades. Meanwhile, government debt as a share of Japan's economy was around 64% in 1990, and it's nearly 240% of GDP today. So how did that happen? How did secular stagnation take hold in Japan? Well, it started with massive demographic change. Japan's population is relatively old and it's shrinking. And in this environment, businesses had less incentive to invest and people had more incentives to save for retirement. On top of that, financial vulnerabilities were allowed to build in the 1980s. And this ended with a stock market crash in the 90s and a brutal downturn afterwards. And hindsight's always 20/20, but with the benefit of this hindsight, some experts in Japan and elsewhere say that the initial monetary and fiscal responses were too tentative. And so as people lived through years of very low inflation, expectations of future inflation just became entrenched at lower levels. And that made it much harder for monetary policy to stimulate demand. Now, some fundamental factors make Canada's situation quite different from Japan's. Canada's population is still rising, thanks to immigration. Immigrants are increasingly joining the labor market, offsetting some of the downward pressure of aging on trend growth. This is very important. Canada's banks are much healthier and better capitalized than Japan's were 30 years ago when the asset bubble burst. And the bedrock of Canada's monetary policy framework has been our inflation target since 1991. And that's something that Japan didn't have until 2012. We have a long track record of achieving our target, and so inflation expectations in Canada are well anchored at around 2%. And because of all this, today, inflation in Canada is at target, unemployment is near historic lows, and wages are growing. Now, household debt accumulation has supported demand in Canada, and this certainly has limits. But the debt-to-disposable income ratio has stabilized. And Canada didn't have to use anywhere near as much policy stimulus as Japan did to get the economy back on track. Now, I expect that people will continue to debate the presence or absence of secular stagnation for many years, and I think this is a good thing. Debate's healthy. But the one thing that we know today is that we live in a world where trend growth is slower than it used to be. And the other thing we know is that R stars, or the neutral rate, are lower. So we need to confront these challenges and do something about it. So it brings me to my second point, which is with the right policy framework, we can navigate a low R-star world. Now, Jay Powell, who you all know is the chairman of the Federal Reserve Board, has aptly said that R-star is a guiding light for monetary policy, but that its location is imprecise and it changes over time, and I think that's bang on. It's definitely hard to pin down what the neutral rate of interest is, but we do know there is a consensus that it's lower than it was in the past. And then we know that in a low R-star world, we're going to have a couple of challenges. Central banks will. Well, it means that central banks need lower interest rates and possibly for longer periods of time to counter the harmful economic shocks and achieve our inflation objectives. It also means that financial vulnerabilities can build, and that building poses risk to future growth. So you won't be surprised to hear that we've been thinking about these challenges. Now, the bank renews its monetary policy mandate every 5 years through an agreement with the Government of Canada, and the next renewal is just around the corner. It's 2021. So we're in the middle of a top-to-bottom review, and this review has 3 pillars. The first is a kind of horse race, and it's a horse race among different policy frameworks where we use model-based simulations to assess their ability to navigate the challenges of a low R-star world. We're looking to see how well they achieve price stability, how they maintain a stable environment for growth and for jobs. Do they support financial stability? And how easy are they to communicate? So you know now that for the past couple of decades, our target has been 2% inflation. It's pretty clear and it's pretty simple and it's worked well. Well, an alternative to that, an alternative possible guide could be to put more weight on past inflation outcomes. And just think about it. In an instance where we undershot inflation for a while, the bank could make up for periods like this by temporarily aiming for inflation that was above target, and it would be vice versa. It's a version of price level targeting. Now, this could give the central bank more room to maneuver by creating expectations that monetary policy will be stimulative for longer periods of time. We're looking at other policy frameworks too. Targeting nominal GDP could give monetary policy more room to maneuver. A dual mandate where we target inflation and full employment could foster a more stable environment for jobs. What we're going to do is have a workshop around the middle of this year to discuss our early results, and the staff will be publishing their working papers as they become available afterwards. The second pillar of our review is refining our toolkit. Over the past decade, central banks around the world have deployed a range of tools, and these have included not just moving interest rates around, but forward guidance about the future interest rate path. Negative nominal interest rates have been tried, large-scale asset purchases, we call QE, as well. And these and other measures have been deployed in the US, in Europe, Japan, among others. It's been long enough to tell that they have prevented far worse outcomes from happening. Even so, it's too early to know what the long-term consequences are when they've been used for an extended period of time. So our third pillar of work is pretty important. What it's about is looking at how fiscal, monetary, and macro-prudential tools could be better aligned or to complement each other. We know that fiscal policy becomes a more powerful force as interest rates fall towards zero. And of course, governments must always keep long-run fiscal sustainability in mind. Now, concerns that policy arsenals won't be sufficient to get the job done in the next downturn have prompted an old idea to pop up, and it's been called direct delivery of stimulus, or helicopter drops. You may have read about those. The basic idea is pretty old. It was first introduced, I think, by Milton Friedman in 1969, and it's simple. It's that the central bank creates money that's then transferred to people, and they spend it. It's essentially fiscal stimulus that's financed by creating money instead of issuing debt. Now, there are serious limitations to this tool. For starters, it would be very difficult to determine how large a dose of helicopter money the economy would need to get back on track. We've got new work by bank staff on this that's going to be published in the coming days or in the next week that shows how this kind of tool could lead to volatility in interest rates, in output, and in inflation. And when I think about it, it's quite reminiscent of the monetary targeting frameworks that we had in the 1970s and the 1980s. But the staff work also shows that an equally effective but less risky option would be to provide fiscal stimulus that's debt financed in the traditional way, in combination with accommodative interest rates from the central bank. A separate line of inquiry is how to strengthen the framework for macroprudential policies, because these policies are what you can aim at keeping financial vulnerabilities in check in a low interest rate environment. And we've said often that that's the best tool to keep financial vulnerabilities in check. And my colleague, Deputy Governor Baudret, spoke last week about the effective use of macroprudential tools and how they can give central banks more leeway to do our core job. As we study these issues, my colleagues and I are exchanging ideas and research with academics and other central banks. You know that the Federal Reserve and the ECB and the Bank of England have embarked on their own review of their frameworks. And we've been engaging with labor and civil society groups to better understand how our policies affect people. Now, we plan to launch an online consultation in the spring. Later this year, we'll publish a report outlining what we learned. So the right monetary policy framework and toolkit are foundational to economic well-being. And that's because they create a stable environment for businesses and households to plan. Monetary policy can only take us so far, though, and we need to remember that. It won't raise trend growth in incomes, and it won't raise the neutral rate of interest either. Canada and other countries will need to do more to support prosperity and avoid suffering from chronically slow growth and weak demand in the future. So this brings me to my third point. Japan-style stagnation is not written in our stars. There's a whole galaxy of ways to boost the trend line for growth and incomes, and in doing so, raise our star, the neutral rate of interest. So let me start with what we can do at home. Boosting trend growth in Canada means focusing on productivity. And it may not be a very popular term or an intuitive term, but it is the way you raise GDP per capita and grow the economic pie. And we know from Canada's history that higher labor productivity leads to higher wages too. Now, the innovation happening in Canada as the economy becomes more digital is already leading to exciting new opportunities. We just take agriculture. Farmers, they're installing sensors to get a constant stream of data on soil conditions, which then they put through algorithms to allow more efficient use of fertilizer and pesticides. And data-driven farming doesn't just boost productivity, it's also good for the environment. The firms in oil and gas are using technology not only to cut costs, but also to improve worker safety and to lower emissions. So one uses natural gas to cogeneration to generate low-cost electricity that's added to Alberta's electricity grid. So digital economic activities are really important for Canada's future. They're really important for Canada right now. They make up about the same share of GDP as mining, oil, and gas combined. And Canada is emerging as a global leader in artificial intelligence. And being in Toronto, I hardly need to tell you that. Now, there may be even more investment in technology than what's showing up in the data. Got to admit that. Digitalization's changing how companies invest, and that's making it tougher for statistical agencies to get an accurate picture of the economy. And this is an important focus of work at the G7 table. The Bank of Canada chairs a group that's studying these data issues. But if we set measurement issues aside, we all know that we could be more productive. Canada trails many other advanced economies on indicators that we know increase productivity and competitiveness of Canadian businesses. For instance, we invest less than many countries in information and communications technology and in R&D. And that's one reason why productivity growth in Canada has lagged the US for many years. And you think, well, how important is that? And so I'll just give you a number. If Canada had the same productivity growth as the US during the 1990s tech boom, our GDP would be 13% higher now. And that's worth $5,000 a person every year for the last 25 years. It's not a central banker's job to be prescriptive here about what to do about that. And so I think it's great that several think tanks and groups have outlined sensible avenues to consider. Though creating opportunities for new markets is a start. It's one recommendation that comes up a lot, and reducing trade barriers between provinces and taking better advantage of newly signed international trade agreements comes up as well. And I think it makes sense. Why not help firms diversify their markets even as they deal with protectionism? Canada needs to catch up with other countries on the diffusion and adoption of technologies. And this involves businesses and governments working together to invest in education and skills training, financial skills, transform digital infrastructure, optimize the tax and regulatory environment. Physical infrastructure programs have come up a lot as well because they can lift the economy's growth potential. In fact, at very low interest rates, there are public policy projects with high social returns that would pay for themselves in the long run. Now, these kinds of policies would raise the trend line for growth in Canada by making us more productive at home and more competitive abroad. So when it comes to raising R-star, the neutral rate, we'd get even more bang for our buck if other countries pushed in the same direction. Reduction of trade uncertainty is the obvious place to start because it would boost global investment. But the G20 also needs to advance efforts to strengthen inclusive growth because success on this front would improve the lives of many and reduce excess savings at the global level. And there's evidence that pensions and other social spending have mitigated the structural decline in interest rates in advanced economies in recent decades. So there's a payoff. Policies like these could restore some lost maneuverability for monetary policy and keep the global economy on a more even keel, benefiting everyone. So it's time to conclude. There's a lot of talk these days about whether advanced economies are experiencing secular stagnation. I don't see this as Canada's reality today. Inflation is at target, unemployment is near historic lows, and real wages are growing. And the fourth industrial revolution is underway, so there's upside to trend growth in the future. The Bank of Canada already has a strong policy framework that has served us well for nearly 3 decades. The work that we're undertaking now to renew our inflation target agreement and the toolkit will only make that framework stronger for a world with low neutral interest rates. I'm going to say just a minute in French for the benefit of our web audience. Oui, l'économie mondiale fait face à des défis sans précédent. Mais je ne pense pas que le Canada ou d'autres économies avancées soient condamnées à la stagnation séculaire. Il faut surtout refuser de voir le faible taux de neutre comme une fatalité. C'est à nous tous, les décideurs publics et les entreprises privées, de faire augmenter la croissance et remonter le taux neutre de façon viable. Il va falloir des politiques fermes et ambitieuses, ici comme à l'étranger. Les avantages sont clairs. On va pouvoir mieux résister au prochain relancement et garantir de nouvelles possibilités à long terme chez nous et dans le monde entier. So, it's true that the global economy is being challenged in unprecedented ways. However, I disagree with the notion that Canada or other advanced economies are doomed to secular stagnation. And part of that is refusing to take the low neutral interest rate as given. It's up to all of us, public policy makers and the private sector, to raise growth in R-star in a sustainable way. It will take decisive, ambitious policies at home and abroad. But the payoff is clear. It will be more resilient Canada in the next downturn and will secure long-term opportunity and prosperity for people in Canada and across the world. Thank you.
Well, why don't you sit right there?
Okay.
Thank you very much for the speech. That was truly engaging and informative. It covered a lot of ground. And so this is my cue for you, the audience, to queue up your question. If you have a question, I'm going to kick things off with one or two. But if you have a question, please stand up or raise your hand, and one of the folks from the Economic Club of Canada will come over to you with a microphone. But one of the things I wanted to start with is you talked at the end of the speech there about productivity. And it seems like in Canada we've been talking that we're about productivity and that we've been lagging the rest of the world for a really long time. And so I guess my question is twofold. One, why is that? What needs to be done, and what could be done? You alluded to a few in your speech. But secondly, I think productivity at times has a bit of a negative connotation among some Canadians, where they think the implication is that Canadian workers are just not working as hard as they could be, and that's really the lag. But of course, that's not what we're talking about. But I welcome your thoughts on that.
No, there's a lot in that question. I think that it wouldn't be true to say that Canadian businesses and workers aren't working hard and aren't striving to do better every day. The fact of the matter is that Canada has shown some productivity growth, and we did benefit from the ICT period, for sure. It's just we didn't benefit as much as the US did. And there's been so many studies looking at why that is. A part of it is just a question of scale. If you've got a bigger country with bigger businesses, you're going to enjoy economies of scale that will allow you to be more productive. But the other parts are parts that I mentioned in my speech. For whatever reason, Canadian businesses don't adopt and deploy technology as much as they do in the US. Doesn't mean we don't do it at all. I'm always amazed by the innovation that happens here. It just suggests that we could do better. And when it comes to workers, especially in this day and age where we talk a lot about digitalization, which will lead some productivity gains, it can strike some worry in the minds of people thinking, well, am I going to be replaced? And in fact, the studies show that parts of people's jobs might be replaced, but very few jobs actually will be completely replaced. What will happen is that people will do their jobs in a different way, or maybe have different jobs using the technology in hand. And that's why the skills training that I talked about in education, learning more about STEM, being more financially literate, are all ingredients to be able to seize the opportunities that are out there.
Right. Great. We'll pause and see if there are any questions from the floor. If not, perhaps I'll ask one more. You mentioned briefly, I have to ask, coronavirus. Obviously, it's sort of dominating the news, and I'd be interested in your thoughts as to how you contextualize, call them new phenomenon that you couldn't have anticipated at the, say, beginning of the year, not an economic indicator. Mm-hmm. And beyond that, how you distinguish kind of the noise or the fear we hear about the actual potential for economic impact, and how you look at those two pieces.
So first and foremost, the coronavirus is a development that's terrible for the people who are involved and their families. It creates a lot of worry and in some cases, unfortunately, a lot of heartbreak. So I would just say that's the most important thing. Clearly, we've seen in the past with similar types of outbreaks that they can affect Canada, even if they're not happening in Canada, or at least not to the extent as today they are in China. And we see that through a number of channels. It can come through lower oil prices, lower commodity prices. We've seen a bit of that. Less travel, so the tourist industry, the transportation industry could find themselves a little offside their forecast for a little while. And at the same time, supply chains. We're already hearing Canadian companies, lobsters being in the news quite a bit, become disrupted. This time, it didn't come at it's never a good time to have an outbreak like this, but when the global economy is feeling a little fragile, we've got mixed data in Canada, it's certainly not great timing. The way to look at it from a policy perspective is to just sort of dissect, well, how would it turn out if it doesn't last very long? That's going to have, that temporary feeling is going to have maybe a look that looks a bit like SARS in 2003. But if it lasts longer, then we'd have to think about what risk management looked like in that space. At the end of the day, what it comes down to for us is looking at the data to see what they point to in terms of confidence of the business, the consumer, and what that means for growth and what that means for meeting our inflation target. We already said that we're looking at all those data, and it just means that we're going to have to concentrate a bit more on it.
Sure. Any questions from the floor? Yes, right over there. She's right behind you, actually, I think.
Oh, okay. Thanks, Carolyn, for your remarks. Hey, just a couple things. So, when you think about Japan, first of all, they were a day late and a yen short in everything they did, right? Both from a fiscal and a monetary policy perspective. And in particular, so the expectations got into the marketplace, as well as all the other factors you talked about. And their fiscal policy was particularly bad and not helpful of productivity, as you were just suggesting. So question for you is, who's supposed to be the one doing all the research on the fiscal tools? Is that something the bank is going to be looking at? Or is it supposed to be the think tanks? Or because obviously that's a big problem with interprovincial trade and all kinds of issues, energy policy, et cetera, that we have. And the second thing is, with regards to stagnation, it's kind of hard not to argue that it's a concern when 30-year interest rates are at 1.5%, and the bank thinks the neutral rate's at 3%. And so, one of the problems that the Bank of Japan did was they were too late to lower their neutral rate, R-star. And so when you chase the market down, you end up with a bad outcome. Do you want to comment on those?
So I'll take that in a couple of parts. Those are great reflections. I'm not going to make a comment on how Japan responded any more than I already did, because when you do policy for long enough, you really are humble about how great hindsight looks. It's a great view to have. At the same time, you did ask about fiscal policies. Well, clearly that's in the realm of the fiscal authority. They're the ones that have a number of objectives that they need to meet, and so it's up to them to look at that. In terms of our inflation control agreement, the work that we're doing it with them. And when we look at the different mix of policies that I talked about, we are doing that jointly because it's really about how they work together and understanding that. And that changes how they work together depending on which fiscal policy is deployed. What sets Canada apart, and I think is quite helpful, is the fact that the federal government has an agreement with the Bank of Canada that they renew every 5 years with respect to the objectives for monetary policy. And that gives us our operational independence to achieve those objectives. But it also means that the fiscal authority, so the government, shares that objective as well. Now, they may have others, but at least they share one that we have. And I think that serves us well. It has certainly over the slowdowns that I've seen, and I've been around for quite a while and seen a few, more than I'd like to see. So that's one thing. What's happening in global markets with respect to long-term yields is a complicated matter because you can look at long-term trends in yields and see that they've been going down for a long time. But at the same time, understanding what's happening there is clouded by the fact that part of it could be a function of what's happening with respect to asset purchases that central banks have been doing for the last 10 years. That mapped with some flight to safety that's been happening and search for yield with a supply, at least in Canada's case, that may not be, of long-term bonds that may not be, mean that to meet the demand, the price needs to rise. So there's a lot of that going on. You did say that I said the neutral rate was 3. I actually said below 3. I corrected myself. So it's between 225 and 325. So it's 275. We're renewing our estimate of that for April. When you look at it, you kind of need to look at the evidence too. There's a lot of models. They all point to around 2.5. Well, between 3. The range I said. But you also have to look at, well, what happened to the Canadian economy when we lowered interest rates? And it recovered. And it recovered at exactly the places that you think it would in terms of the transmission. It encouraged people to buy houses and consume more. Business investment was probably stronger than it would have been otherwise. And the economy was able to recover from first the Great Recession, okay, the crisis, and then afterwards the oil price shock. There's still some adjustments going on there. And that wouldn't have happened if monetary policy hadn't been stimulative. So the neutral rate has to be positive, and it has to be a higher level than where we have interest rates now. At least that's what the evidence points to.
Any other questions from the floor? Yes, right over here.
There's a question on productivity. Not only is there a gap between nations, there's a gap between frontier firms and SMEs, and that's increasingly, the case in the North Atlantic world. And I'm wondering what prescriptions that you might have or insights you might have on that, since SMEs are, at least half the economy, and since productivity is not everything, but as Krugman says, it's in the long run, it's almost everything. Yeah. Thank you.
Well, there's a lot of elements in there, and the Organization for Economic Cooperation and Development, OECD, has really amazing detailed industry-level detail on this. My take from that research, but also just talking to firms. We go around the country and we talk to firms quite a bit, and there are a number of factors that get in the way of more productivity that they would point to, or more competitiveness. And I think the top one is just the regulatory framework in Canada with different levels of government, where, and this isn't a criticism of it, I'm just saying what we hear, that really makes it hard, because if you imagine you're a smaller firm and you only have a few people, you've got a lot fewer people to devote to regulatory compliance and going through the hoops that are required. And so that's one thing. And I think the second thing would be talent. So there's a lot of fantastic students coming out of Canadian educational institutions. You see that in the numbers. It's just that the match with the skills that they have and what these firms need as soon as they start is not quite what they would like it to be. And there's a shortage of those people. And so that's one of the reasons I mentioned the education and the training part. For bigger enterprises, they can train up their workforce. They've got the number of staff to cover for people as they're on training. But when you're a smaller firm, at 20, 30 people, there's 100 people, you can't do that as easily. And if you've made that big investment and they come back and then go off and work for a big firm, you've also lost that investment. And so these are the things that you would hear from small and medium-sized enterprises that get in the way. And the question is there anything that can be done to make that those training and other decisions easier?
Any others? Perhaps I could ask a question about digital currencies, and I know the bank is working with several other central banks to look at digital currencies, and perhaps you could explain to I've heard some question, doesn't Canada already have a digital currency, and isn't it called the Canadian dollar, and that money just moves digitally now, and so I guess that'd be a bit of perhaps a simplistic view, but your views in the bank's general interest in digital currencies and what you've heard from other central bankers.
Sure. So Canada's been working on crypto assets and digital currencies for a number of years. In fact, since about 2014, and we've undertaken a lot of projects using different kinds of technology, primarily blockchain-based technologies, to study this, as well as just understand what's the place of digital currency in our system, and what does it mean for financial institutions, what does it mean for people? And those questions come up a lot. Well, what's the difference? I take out my debit card and I pay. And what's the difference between that and a digital currency that was backed by a central bank. And it's quite simple. The difference is it's backed by a central bank.
Right.
So I just saw in the news today a study that came out, I think by OMFIF, that was asking people, and probably in their universe, would they prefer a private sector digital currency or a central bank digital currency? And it was resounding, was the central bank. And I don't think it's because people think that we have an edge on technology. I don't think it's that. It's because they think that we have a balance sheet that we can stand behind. And we have a reputation for preserving the confidence and the value of the currency.
Sure. Excellent. Well, I know we're at time. We probably could have gone a lot longer, but on behalf of the group here today, I wanted to thank you both for your formal remarks and your candor in answering
Pleasure.
questions, and I wanted to invite Megan back to the podium.
Great, thank you so much. I would reiterate, it was fascinating to have you here, Ms. Wilkins. I think having a conversation not just about the tools and decisions of the Bank of Canada, but I liked how you explained the sort of decision tree you go through, the different collaborative nature. I don't think we often get to hear that goes on there, so that was really beneficial to me. To wrap our engaging event, I would definitely like to also thank Neil as well as Carolyn for joining us today, so please join me in giving them a round of applause.